Hello everyone, welcome to Betty Academy. Our job is to make school easier. Kindly subscribe, watch our videos, like, share, comment down below, and don't forget to hit the notification bell. So in this lesson, we are going to learn about capital structure theory, that is about Modigliani and Mila, otherwise referred to as approach. So under that, the Modigliani and Mila approach to capital theory, it was devised in the 1950s. Basically, they are the advocates for the capital structure irrelevancy theory. This suggests that the valuation of a firm is irrelevant to the capital structure of a firm. Yeah, so when you are valuing a firm, it is not relevant to the capital structure of a firm. So whether a firm is high on leverage or has a lower debt component has no bearing on its market value. Yeah, so you remember when you're sourcing for funds, there's that debt component together with the equity component. So what they are saying is whether a firm is high on leverage, that is on debt, or has a lower debt component, it has no bearing on its market value. Rather, the market value of a firm is solely dependent on the operating profits of the company. So what they are saying is that the value of a firm is solely dependent on the operating profits of the company. So the capital structure of a company is the way a company finances its assets. A company can finance its operations by either equity or different combinations of debt and equity. The capital structure of a company can have a majority of the debt component or a majority of equity or an even mix of both debt and equity. Each approach each approach has its own set of advantages and disadvantages. There are various capital structure theories that attempt to establish a relationship between the financial leverage of a company, that is, the proportion of debt in the company's capital structure, with its market value. One such approach is the Modigliani and Mila approach. So the approach was devised by Modigliani and Mila during the 1950s. The fundamentals of Modigliani and Mila approach resemble that of the net operating income approach. So Modigliani and Mila, they advocate for capital structure irrelevancy theory, which suggests that the valuation of a firm is irrelevant to the capital structure of a company. Whether a firm is high on leverage or has a lower debt component in the financing mix has no bearing on the value of a firm. So the Modigliani and Mila approach, they further state that the operating income affects the market value of the firm, apart from the risk involved in the investment. The theory stated that the value of the firm is not dependent on the choice of capital structure or financing decisions of the firm. Yeah, so when you are dealing with the financing decisions, that's when you look into the aspect of sourcing of the sources of the finance. And again, the sources of finance what comes in handy is the cost of finance that has to accompany any type of source of finance that a firm may go for. So there are those assumptions. Yeah, for Modigliani and Miller approach, there are those assumptions that they have under their approach. One, they are assuming that there are no taxes. Yeah, so they are assuming that when they are doing the evaluation, there are no taxes. Again, the other one is that the transaction cost for buying and selling securities, as well as the bankruptcy cost, is nil. There is no transaction cost for buying and selling of securities. Then the other assumption is that there is a symmetry of information. By symmetry of information, it means that an investor will have access to the same information that a corporation would, and investors will thus behave rationally, meaning that information is accessible by all investors. Generally, it can be accessed by any person. So it means that the behavior of corporation as well as the investors, they will behave rationally. The other assumption is the cost of borrowing is the same for investors and companies. Yeah, so if you go as an investor, the cost of borrowing is the same as companies, right? Then the other one is there is no flotation cost, such as underwriting commission. Yeah, when you are issuing the shares to the public, it means that there is no flotation cost, such as underwriting commission, payment to merchant bankers, advertisement expenses, etc. All those ones are not there. The other assumption is that there is no corporate dividend tax. Yeah, there is no corporate dividend tax. It's another assumption for M&M approach to hold. So the Modigliani and Mila approach indicates that the value of a leveraged firm, that is a firm that has a mix of debt and equity, is the same as the value of an unleveraged firm, a firm that is wholly financed by equity, meaning they've not borrowed not even a single cent. If the operating profits and future prospects are the same, yeah, or even those ones are the same, that is, if an investor purchases shares of a leveraged firm, it would cost him the same as buying the shares of an unleveraged firm. Yeah, so those ones are under MM. So under Modigliani and Miller approach, they have two prepositions. Yeah, those ones that fall without two prepositions without taxes, and the two prepositions without taxes, these are the prepositions. We have the preposition 1 and preposition 2. So under preposition 1, if you look at it, with the above assumptions of no taxes, right? We remember preposition 1 and 2, they are assuming there are no taxes. The capital structure does not influence the valuation of a firm. In other words, leveraging the company does not increase the market value of the firm or of the company. It also suggests that debt holders in the company and equity shareholders, they have the same priority. That is, earnings are equally split amongst them. Yeah, yeah. So there is no one who has more advantage than the other one. Then under preposition 2, it says that financial leverage is in direct proportion to the cost of equity, right? With an increase in the debt component, the equity shareholders perceive a higher risk to the company, right? So the higher the debt component, because remember the capital structure has two components. There's the debt component together with the equity component. So it means that with an increase in the debt component, it means that they are losing control of their firm, because basically the equity shareholders, they are the owners of that particular firm and they have control of that particular firm. So they perceive that it's a higher risk to the company, because they may end up losing the control of that particular firm. Hence, in return, the shareholders expect a higher return, right? Yeah, you remember the risk return trade-off, what it means. The higher the risk, the higher the return. So what does that one mean? Thereby, they increase the cost of equity, right? So that is the effect. Yeah, if they perceive that the debt component is increasing, they also increase the cost of equity. So a key distinction here is that preposition 2 assumes that debt shareholders have the upper hand as far as the claim on earnings is concerned. Thus, the cost of debt reduces, right? So I hope we are together up to that particular point, and I hope you've understood something. So we have those prepositions. Yeah, just a recap. We have those preposition 1 and preposition 2. Those ones assume that there are no taxes. So that's the end of our lesson. Until next time, please watch out for the next video, and don't forget to subscribe and hit on the notification bell. Until next time, goodbye.